Sales. Stop wasting time searching the web to find emails. Peoplesmart.com is the faster way to find emails and phone numbers for your business. Saving time means closing more deals. Peoplesmart.com. Start prospecting faster than ever today.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the shore.
Giant container ship blocking the Suez Canal.
1,000 new types of crypto coins.
Crackdown on tech in China. In the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs you love.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
Around about 20 seconds, 23 seconds, 22 seconds away from the opening bell from New York is the price action for you. Up 5 on the S&P, advancing about 1/10%. Record high at a close yesterday. The stat master, Katie Lyons, saying we've had 70 of them, the most since 1995 when we had, I think, 77. There's the opening bell. Switch on the board and get to the bond market. 10-year yields look like this after pushing higher back through 150 yesterday. Up 6 or 7 basis points on 10s in yesterday's session. This morning down 2 to 152.55. Euro dollar had the high of the year in the first week of the year, 123.27. Week 1 at 21. And now, at the end of the year, 113.21 and down 1/4% on the day. Crude, 76.84, up 0.4%. Your opening bell. Right now, your equity market up 1/10% on the S&P, advancing just a little bit. Consumer discretionary down 1/4%. Real estate basically unchanged, top of the pile. Staples, utilities, financials, healthcare, not much price action to speak of. The S&P 500 clocking another all-time high with 21 trading, coming to a close in about 24 hours, 36 hours, whatever it is. G-Squared's Victoria Green expecting stocks to continue climbing higher.
If you look at fundamentals of stocks, they're actually very strong. People have, the consumer has good balance sheets. Look at the Christmas spending. Everybody wanted to scream supply chain, supply chain. We're never going to, be able to, poor Santa is going to get stuck in the North Pole and not deliver presents. But we saw massive spending. It was like up almost record levels according to MasterCard. So you have healthy consumers, healthy corporate balance sheets, growing earnings. You can climb the wall of worry.
Joining us now to discuss, Sarah Hunt of Alpine Woods Capital and Malcolm Etheridge of CIC Wealth. Let's begin with you if we can, Sarah. Your big call for 2022, what is it?
I think valuations are actually going to start to matter a little bit more. I think you have to deal with all of the issues that are coming from the Fed backing down a little bit, which means that the liquidity issue is going away to the extent that it's been pushing a lot of stocks that have not had a great fundamental situation. So I think that as we get into 2022, that's actually going to start to matter.
Malcolm, this year all about earnings. Next year, is it about multiples?
It probably has more to do with fundamentals and multiples because you'll have a lot more institutional traders participating than retail traders. Like this year, we saw a lot of price action and a lot of participation from retail traders that we just don't expect to see happen again next year. And one key indicator for that is we've already seen interest in trading among our own clients wane, right? So as individuals turn their attention to other things, there's just far fewer clients interested in discussing names like Peloton and Zoom and GameStop and Bitcoin than there were back in the summer, just as there are far fewer people downloading Robinhood's app these days.
What do you think the catalyst is for that, Malcolm?
Well, one thing, we're already talking about the money supply being not as easily accessible, not as cheap, right? So as we talk about the 10-year ticking above 1.5, let's say it gets to 175 and looks like it's going to approach 2, God forbid, right? That then means that mortgage rates are significantly higher than they have been for a while, which means that all these cash out refinances that have been happening that have people spending money at Lowe's and Home Depot and Sherwin-Williams and everywhere else, there's just not people running around the streets with this extra money, quote unquote, in their hands. And that then translates to people not feeling as rich, at least no matter what their home balance sheets look like. They're not participating in the markets because they're now focused on making student loan payments, making credit card payments, making, utility payments, all those things that have kind of been put on pause. Maybe you haven't had to worry so much about it in the last couple of years.
Sarah, can you respond to that? How much of a contribution you think there has been from what Malcolm just described?
Well, you know, what's interesting, it reminded me of the mortgage equity withdrawal discussion that we were having in 2007 going into 2008 because there was a lot of money coming out of cashing out then as well. I think you have had the last couple of years a lot of forbearance on certain payments, and I think that that is going to be an issue going forward because you don't see as much forbearance and you don't see the excess unemployment on the fiscal side that you were seeing. So you have both the Fed backing off and fiscal support backing off, and I think that that is an issue for individuals.
I do wonder what that means for the cyclical parts of this equity market. One airline stock story we've been talking about throughout the whole of this week has been the cancellations piling up over the holiday weekend. That story continues. I want to bring in Abigail Doolittle for more on that. Hey, Abby.
Hey, John. Well, you know, it's interesting because I was thinking of flying to Florida next weekend. Not so much. JetBlue just today canceling nearly 1,300 flights going into 2022. That's about 10% of their total flight offerings on the Omicron disruptions that we have seen more recently. Over the last 5 days, including today, more than 1,000 flight cancellations each day. This as crew are unable to go or passengers also having issues there. But Omicron really disrupting the airlines here in the U.S. for sure. Investors, however, taking in stride. The stocks right now not plunging. In fact, mixed, more green on the screen than not. That could have to do with the fact that the airline index on the year down about 2% versus the S&P 500 up 28%. So maybe investors all year have been pricing in some sort of possible disruption that we are seeing now. One thing is clear, though. These airline companies very much incentivized to get as many planes back into the air as possible. Debt has absolutely ballooned. Delta, their debt has doubled. In 2019, $14 billion, now greater than $31 billion. Again, companies have the incentive to get their planes in the air. Let's see whether or not it happens, though, in 2022 with these Omicron disruptions.
Abby, thank you. I wanted to come back to you, Malcolm, on not just this sector, but more broadly, the reopening story of 12 months ago. If you think back 12 months, looking ahead 12 months, we were all talking about the reopening of the economy, the airlines. That story stalled out in spring, in the equity market at least. Your 10-year yield, that story topped at the end of March, the end of Q1. I feel like we're having this conversation almost again, Malcolm. People are talking about next year, the reopening of let's get back to business. This is the year of normalization, not just in America, but worldwide. Malcolm, what are your thoughts on that dynamic?
Well, we do expect travel to actually be a surprise next year as it becomes a little bit easier to travel. It becomes a little bit safer to travel. People feel more comfortable. We think that that is one place that all of a sudden has become inelastic, right? Airline travel for most people, at least, you know, recreationally, was sort of an elastic good. And now we expect it to become sort of inelastic as we are able to move around a little bit more freely. We have more people vaccinated. We have far fewer people getting hospitalized and that sort of thing. And we do expect that the airline supply will actually raise to meet the demand at some point. So eventually that graph starts to look more in line. Right now it's completely out of whack where you have far more demand from consumers than you do actual supply from the airlines. And part of the reason that the CDC changed up their guidelines as far as the 5 days versus 10 versus 14 it initially was, is because airlines are saying we can't get our staff back on these planes fast enough to help work with and kind of herd these cats a little bit. We need these people back to work, and your protocols for quarantine are just so tough on them that we can't put people in the sky. And so I think those two things will sort of come back in alignment next year, and you'll still have tons of demand of people wanting to get out and make up for lost time.
Sarah, let's talk about whether that translates into a positive mood in the equity market, the potential for a Q1 repeat in 22, a Q1 21 repeat in 22. Sarah, what's the potential for that?
Well, I think that you absolutely have the sort of pandemic fatigue that people have been talking about. So I think that the excitement when the vaccines were coming last year for the first quarter, I think you're going to, as we get through Omicron, and I think that we will get through it, and I don't disagree that as it gets less severe, people are just saying we're going to go out anyway. Prior to this wave, you had domestic traffic, air traffic, close to where it was before the pandemic. It was international traffic that's still very much curtailed. So I do think that you're going to see a lot of enthusiasm for people to get out and do things because they're tired of staying at home and they're tired of not seeing people. But this particular wave has definitely slowed that down.
I want to turn now to the inflation story of the year, which has been a big surprise for many people in 2021. Not everyone, but for many. Militaybac's Matt Maley saying the following: if inflation remains strong, consumer confidence will begin to wane. At some point, the higher prices cause consumers to pull in their horns, and that will hurt profits in our consumer-driven economy. With more on that, here's Bloomberg's Kelly Lyons.
Well, John, the profits is really the key part here, because when we talk about what's driving the bullish thesis in the year ahead, everybody points to continually strong corporate earnings. And of course, when we're talking about profits and inflation, what we're really talking about is margins. To this point, margins have held in. They're actually expanded in most of the major industry groups within the U.S. equity market in the third quarter. But companies are still facing higher input costs, labor pressures. All of that can hit the bottom line. And what we're looking at there in white is the 12-month forward operating margin estimate for S&P 500 companies. It has flatlined over the last several months. Really, it all comes down to the ability to pass those costs on. Pricing power is the name of the game here. And staples companies, for example, really trying their best to exercise that. Food prices are expected to rise 5% in the first half of next year. Mondelez, General Mills, Campbell Soup, Kraft Heinz, all saying that they will implement more price hikes come January, and that's benefiting those stocks. They're on pace for their best month in about 20 years. But the thing is, the pricing power only works so long as consumers tolerate those higher prices. And with inflation this high, talking near 7%, at what point, to Matt Maley's point, does that tolerance start to wane, demand start to pull back, and start to pose a threat to profits, John?
Katie, thank you. We've dedicated a lot of time to this story through much of this year, through 2021. Cathie Wood, obviously with skin in the game, has this to say overnight. In our view, fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months. If so, the rapid growth rates of truly innovative companies, many of their equities maligned through much of this year, should be rewarded handsomely. To respond to that, I'm pleased to say that Sarah and Malcolm are still with us. So Sarah, respond to that for us. We've talked a lot about this inflation story, what it could mean for the equity market. Yes, Cathie Wood is talking her book a little bit. Yes, she has skin in the game. But can you respond to what she's got to say on this, that fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months?
Well, if you think about the fact that high inflation, especially in things like food and energy, is very difficult for spending, then you obviously have an issue with what's going to happen with markets, and people will start worrying that the economy is really going to slow down enough. I think she's not wrong that innovative companies will be rewarded, but I think at this point they really have to be innovative companies that can show a path or already profitable, because at this point you don't have the backstop of money being cheaper and completely available everywhere. So I think that's one of the places where there's a little bit of a difference, to my opinion, about what will be rewarded if we do start to worry about a recession. Growth will continue to be rewarded. It's the unfortunate thing for value that it hasn't really had a moment in the sun in the last 2 years.
Malcolm, your response, please.
So I think one of the things that also is getting lost in this conversation about inflation is the fact that we're having such a strong war for talent still at the hourly worker level, right? So we're talking about a lot of the service jobs, those sorts of things that normally haven't really had their chance to fight for higher wages. And we think that as long as the hourly worker is having their day in the sun, so to speak, where folks are competing to get their attention, and even shops, right across the street, right down the street from each other are competing for workers in smaller towns, the wages continue to grow, and hourly workers are usually the ones who spend faster and more quickly than white collar jobs. So we will see those dollars continue to flood the system and go after goods and services. And so as long as there's more dollars chasing fewer goods like we have right now, because the hourly worker has more dollars in their pocket to spend on consumer staples, especially, the inflation conversation about packaged goods and things like that we were just talking about in the clip before will continue to go up. But if we're talking about, bigger, more grand ideas like Cathie Wood is talking, it really comes back to the money supply part of the conversation. And if those dollars aren't as cheap for corporations to go borrow, it becomes very tough to invest in R&D to see that innovation that she's looking for.
Malcolm, 2 points though, and let's pick up on the first one. It makes me think of margins almost immediately. Are you thinking sector to sector of the labor intensity of each sector? And if wages are going to continue to be seeing this higher pressure, better wages, better growth in them, are you avoiding certain sectors over others?
Well, we're not necessarily avoiding other sectors over others yet, because the companies always have the ability to pass those higher costs on to their consumers. And as long as, like I said, the hourly workers are out there to consume, they have dollars to consume, then nobody's really crying foul too hard about the higher prices. It's when the wages stop growing, right? We stop seeing Amazon commercials where they're advertising a higher hourly wage than anybody else. When we stop seeing those sorts of commercials and the yard signs, in front of the local business, enticing folks to come in for an extra, $1 an hour, when that calms down, then we'll know that we have some cause to be concerned.
Sarah Hunt, you get the final word on this, please.
I think we also have to really look at the energy situation, because if you look at what's going on with Europe right now, you're seeing some curtailment of production because of higher energy prices. And I think that that is something that is becoming a little bit more systemic than people thought. And the fact that you've had a much less demand picture in the last couple of years because of COVID has somewhat masked that. But I think that that is part of the systemic aspect of this inflation, is that your input costs are going up as well. And I think that's something that's going to be forefront into 2022 as well.
Sarah, thank you for everything. As always, Sarah Hunt and Malcolm Etheridge, and a Happy New Year to you both as well. Coming up on the programme, President Biden preparing to speak to Russia's Putin amid concerns over Ukraine.
This is a big wild card for next year. I think for the time being, Vladimir Putin has to worry about a guerrilla war if he invades eastern Ukraine.
That conversation still ahead from New York. This is Bloomberg.
This is Bloomberg The Open. I'm Rishka Gupta, live in the principal room. Coming up, Howard Lorber, the Douglas Elliman Realty Chairman. That conversation 10:30 a.m. Eastern. This is Bloomberg.
We can characterize Russia's capacity in one word, and that is that it's a spoiler and a disruptor. The phone call today between Biden and Putin is also a way of saying, of Moscow saying, we have ways of making your lives difficult. We are a force to be reckoned with. We have real leverage in these discussions, and don't forget about us.
There is a phone call today between the President of the United States and the President of Russia, set to take place sometime between 3 and 4 p.m. Eastern Time. The talks taking place before January NATO negotiations. I'm pleased to say that joining us now is Bloomberg's Justin Blum from D.C. Morning, Justin.
Good morning. Thanks so much for having me. The two sides are scheduled to talk at 3:30 this afternoon, and Putin asked for the call. Putin is demanding security guarantees from the West that include a halt to NATO expansion and the withdrawal of NATO forces in Europe to positions they held back in 1997. Biden's agenda is much more clear. He's going to be pushing, again, Putin to withdraw forces that are amassed on the Ukraine border.
Justin, is it encouraging that it's the Russian leader seeking dialogue here?
I'm not sure if it's encouraging. It's Putin trying to push his agenda ahead of additional talks that are planned in January. The two sides are talking, so perhaps that's encouraging. Biden says that he appreciates leader-to-leader conversations and thinks that's the most useful dialogue in this situation.
As Justin points out, that call taking place at 3:30 Eastern. Looking forward to your coverage, sir, down in Washington. Bloomberg's very own Justin Blum. A ton of economic data we need to talk about through the year, but this week particularly, just a little sprinkle. Jobless claims sub 200, 198,000. These are the kind of data points we want to see more of. Joining us to discuss, I'm pleased to say, is Yelena Shuletseva of Bloomberg Economics. Yelena, we've finally started getting down to these levels over the last couple of months. How encouraging is that for you?
I think it's very encouraging. The seasonals were expecting a small increase in jobless claims. Instead, we saw easing in jobless claims. And that tells you that companies are eager to save the existing labor force, and they're holding on to existing workers. I think it's also very important to note that I think people at the lower income spectrum will continue to have the pricing power in terms of wages. They will continue to enjoy that pricing power because there's an absolute lack of workers in those professions, in leisure and hospitality, in warehousing professions, due to less of blue-collar workers just being available. I think we will continue to see increases in wages, and in fact, if you talk about inflation versus wages, you see that the wage income is actually at the highest growth rate at 8.6% for the year as a whole since 1984. Yes, inflation is high, probably the highest since '82, but wages are rising as well.
Yelena, this is all good news, and I don't know anyone that does not want to see us get back to where we were before the pandemic. When they look at the participation rate, the employment to population ratio, where there will always be a debate and disagreement as to how you get there, what policy tools you need to use. Do you see reasons to believe it is achievable, though, Yelena, that we can get back to those pre-pandemic levels when you look at things like the employment to population ratio?
I think in terms of participation, I think we will not get there, at least not in the short run. I think it's quite a long time away from us. I think what we need to take care of is the pandemic, and that's what the Fed keeps talking about, that this is at the center of all the policy decisions, in fact. So I think until we really have it under control, and I mean like really have it under control without all these new spikes and restrictions, we will not see people going back. And the longer we wait for that, the less likely we get to pre-pandemic levels, because people adjust to the new ways. Look, we are talking like I'm working from home. Yeah. We're talking about that over the Skype. So I think that's what we face. This is the new reality. Some people just won't go back to work, and will be happy to live on one income if it's a two-person household. So I think we are not going back to the pre-pandemic levels, unfortunately.
Well, the key word's happy. So long as they're happy about that, Yelena, who are we to complain? Yelena, thank you. Yelena Shuletseva of Bloomberg Economics on some of the data we've seen this morning and, of course, through much of this year. Your equity market positive a tenth with some brief sector price action. Here's Abby.
Well, John, on this morning, we have relatively muted sector action, as has been the case all week. Up top, the cyclical sectors, including energy, financials, and then comm services, your Googles and Twitters sneaking in there. On bottom, tech. Now, on the year, it's super interesting, and actually energy up 0.6%. On the year, that, of course, is the top sector, up 48%. Its best year ever, going back to when records were kept in 1990. Financials up 36%, the best year since 1997. This as yields have backed up in a huge way. That 10-year yield up 60 basis points. But tech also among the top, which is interesting only because valuation comes into concern. Let's see how it plays out in 2022.
Abby, thank you. Coming up next, your trading diary from New York. This is Bloomberg. Twenty-five, 26 minutes into the session, another all-time high close. On the cards, perhaps, up a little more than a tenth. The Russell outperforms up 0.7 on the Nasdaq, up a tenth on the S&P, just short of 4,800. That's the price action. Let's get to the trading diary. First of all, in the diary already, 3:30 Eastern, a call between the President of the United States, Joe Biden, and the President of Russia too. The US bond market closing early tomorrow. Remember that for the holiday weekend. Next week, ISM manufacturing, the ADP report, and the main event. Payroll's just around the corner too. Before we get there, let me say thank you. Thank you for choosing Bloomberg TV, and thank you for choosing to spend your mornings with me. I'm looking forward to being with you in 2022. From New York City, this was the countdown to the open. This is Bloomberg. Have a very happy New Year.
Why pay over $100 a month for cable when it's half the cost for Fubo TV? Get all the channels you want with all the entertainment you love for the price that cable can't beat. Try free.
What does the future of strength look like? It's dynamic weight that adjusts for you in real time for a more efficient workout. And you can only experience it on Tonal.
Let's be real. Sales is a numbers game. PeopleSmart.com can turn your list of prospects into accurate emails and direct dials, helping you hit that number faster and easier. Prospect smarter with PeopleSmart.com.
Good Thursday morning. Welcome to Bloomberg Markets. In this special coverage of the week between Christmas and New Year's, we hit a 70th record close yesterday, aiming for a 71st today, and we are simulcasting this program on Bloomberg Radio and on Bloomberg Television. Paul Sweeney joins me out of New York. I'm Matt Miller here in Berlin. So, Paul, not a lot of momentum and obviously almost no volume, but we have another record high. And I always remind people, it doesn't really matter if you have no volume. For people who are long this markets, they are now wealthier than they were the day before.
They are marking to market, Matt. And again, just a little bit of a lift here in the equity markets here, but we'll take it. You know, again, low volume, but that's what you expect here on a week between Christmas and New Year's. But we are here, and we are simulcasting. We're doing it all week, and we're bringing some smart folks here, getting a look at the markets, and also taking a look ahead to 2022. So again, yeah, the S&P up about almost 0.2%. Let's see where the movers are, Matt, with Abigail Doolittle. She joins us here with some market movers. Abigail, what are you looking at?
Well, more broadly first, Paul, to your point and what you and Matt are both talking about, gains. You are wealthier today if you invested $1 yesterday, but very, very small gains, and also on that light volume, greater than 40% below the 20-day moving average. Now, interestingly, bonds, they are down just a little bit, or excuse me, higher. Yields are down just a little bit, but so fractional, it's in keeping with these tiny, tiny moves. And then crude oil up about 0.6%, 0.7%. So you can make the case that there's a little bit of a risk appetite here, but very, very modest.
Strategists are not optimistic for stocks in 2022. And indeed, I've spoken with a couple of portfolio managers who think we're not going to see the kind of returns that we've gotten used to over the past 3 years.
You know, Matt, it's interesting, actually, because the average forecast for the S&P 500 at the end of the year, I believe, is 5,000 or thereabouts. So that does suggest that there could be some sort of a gain. Yes, less than this year. If the high estimate on the street of 5330, I believe, is hit, that would be a double-digit gain, so not so shabby. But perhaps what some of the strategists you've been talking to are concerned about, the inflation fears everybody is worried about, because, of course, operating margins are starting to stagnate, and companies trying to figure out how to manage these rising input costs. Will consumers pay for them? One of the best groups in this month of December, the consumer staples, because of that expectation that prices are about to rise. But will consumers continue to pay? We don't know. As for some of those movers, Biogen down after Samsung said they are not buying Biogen, which makes sense given that Samsung is an electronic company and Biogen is clearly a biotech company. Tesla, they've recalled 500,000 cars. On the upside, though, Ford is higher, as is Carnival. I don't know how many people are looking to get on a cruise right now with Omicron, but that stock is finally
Me and Paul.
popping. You and Paul,
Me and
okay.
Paul we're making our reservations.
Yeah.
We're going to
cruiser.
Where
We're going to go on
Alaska?
on a cruise. I don't think we've decided yet, but neither one of us has been on a big time commercial cruise. Is that right, Paul?
Yeah, I have not.
And so,
but I would do it, but maybe not right now.
Yeah, no, I mean, we're going to make reservations, but yes, maybe for 2024. All right, Abigail Doolittle, thanks very much for catching us up on those markets. Let's bring in David Jones right now, B of A Global Research Senior Investment Strategist, and get his take on 2022 expectations as we near the end of this year with 26% gains right now on the S&P 500. What are you looking for in the coming year?
Yeah, I guess I have to say I'm one of those more bearish strategists at the moment. We certainly think that returns in the next year are probably going to be low single digits, perhaps even negative. And at the broadest level, our view is informed by the idea that rates are going up, liquidity is going down, and profit growth is slowing. And that's just a very hard environment for equities to perform at the levels we've seen over the last few years, particularly when you start at the valuations that we're starting at now.
Yeah, that's kind of where I wanted to go, David, to get your sense of valuation. There's a couple camps out there. One is, boy, this equity market's richly valued. But then another camp will come in and say, yeah, but look where interest rates are. The 10-year just still at 1.5%. So put it in that context, maybe the valuations aren't so high. How do you think about it?
Well, that's really the key, isn't it? It's where interest rates are. This market has really been a product of Fed stimulus and Fed policy. And as long as that can continue, then you can see the market continue to perform the way it has. But the thing is, it's not going to continue. The Fed has already signaled that it's going to tighten, remove accommodations. Certainly, it's sped up the pace of the taper. And the Fed itself, through its SEP dot, says it's going to hike perhaps 3 times in the next year. We actually think the Fed is probably going to have to do a little more than that. So interest rates are certainly on the way up. And that's probably going to affect some of the asset allocation going forward.
So you think the Fed will hike 4 times in 2022?
Yeah, potentially even more than that. You're really in a situation at the moment where the Fed is certainly hiking. The question is whether it's hiking into an acceleration or whether it's hiking into a deceleration. At the moment, the economic data look good, and our economists think that growth is going to be still fairly robust. So if you're hiking into an acceleration, you're probably going to have to do even more tightening than the market has currently priced in. So what we think that leads to is that you're going to have a rate shock in the first half of next year, and you're probably going to have a little bit of a growth scare in the second half as the curve starts to flatten very sharply or perhaps even invert.
All right, so if we have a rate shock, a growth shock, what are you advising your clients to do with if they're allocating capital to the markets next year, where should they go?
Well, we think, the smart bet is to look at some of the quality defensives, so staples and utilities globally, perhaps even more outside the U.S. than inside the U.S. Our view is that, look, if central banks can thread the needle and bring down inflation by raising rates, but not hurt growth substantially, well, then perhaps in that scenario, the optimal allocation would be some sort of barbell where you have equities that do well in inflation, such as energy, such as materials, and then barbell that with quality defensives like staples and utilities. Or if you get something that we think may occur or has a higher likelihood of occurring than the market has priced, and that is a growth slowdown or recession scare in the second half, you're still going to want to have quality defensives. So either way, quality defensives are a good bet, either as a hedge or as an outright long.
But not bonds, right? I mean, if you expect 3, 4, 5 rate rises in 2022, you don't want to hold you don't want to hold treasuries.
Certainly not at the short end, but if you start to see an inversion of the curve and a flattening of the curve, in that scenario, you certainly want to be long dollar and perhaps even longer bonds. But we think that's probably not our consensus benchmark view.
So, David, again, you just mentioned the dollar. I mean, I'm searching for a bear case for the U.S. dollar, but speaking to people like you who think about this rising interest rate environment and how it may even be more aggressive than the Fed is signaling, it's tough to come up with a bear case for the dollar, isn't it?
It really is. I mean, you can, of course, always come up with conceptually a scenario in which the dollar would weaken. Perhaps if Omicron were to turn out to be worse, or God forbid, there were even something more aggressive and more lethal down the road, well, then you could then have a scenario where the Fed actually perhaps pauses or resumes some of its emergency liquidity facilities in the event of a resumption of a lockdown. In that case, of course, you could see the dollar start to weaken, or if the cases are more severe in the U.S. than the rest of the world.
David, what do you think happens to the Fed balance sheet? I mean, if they're raising rates by so much, are they winding that down?
Probably not now. They're probably going to reinvest, maturing issues. They had the experience a few years ago where they were unsure how far to bring down the balance sheet, and they basically had to run into the point where the curve steepens, and then they had the issues in the repo market. So now they have a better sense of like how far they can conceptually bring down the balance sheet, but they're several $1 billion above that. So I don't think they reduce the balance sheet quite yet, but even if they do, they have plenty of room to do so.
All right. David, thank you so much for joining us. Really appreciate getting your thoughts. David Jones, he's BofA Global Research Chief Strategist. A little bit bearish call out there. Interesting to get. We'll have more coming up.